Hi, everyone, and welcome. Thanks so much for joining us for another session hosted by the Spain-US Chamber of Commerce. As always, it's a pleasure to bring together professionals and business leaders to explore trends and technologies that are transforming the business landscape. My name is Beatriz Bellera, and I'll be your moderator for today's webinar, held in collaboration with my investment path. Before we begin the webinar, and for those joining us for the first time, let me briefly introduce the Spain-US Chamber of Commerce. We are a nonprofit organization dedicated to helping businesses expand into the United States through international consulting, events, networking opportunities, and informative sessions. If you'd like to learn more about our services and events, you can visit our website, www.spainuschamber.com. Our website is updated daily, so you can be aware of the lasted events and activities. Just a quick note that this session is being recorded, so you'll be able to watch it again or share it with colleagues or friends who you think might find it helpful. At the end of the session, we'll open a Q&A segment. So please feel free to submit your questions at any time using the Questions tab on the right side of your control panel. In this webinar, we'll walk through the key steps to finish the year strong and set up a solid financial plan for 2026. We'll look at where you stand today, budgeting, cash flow planning, and a quick financial health check. We'll also cover how to protect yourself against unexpected events with smart health insurance planning, risk management, and emergency reserves. Finally, we'll review whether your company's legal or compensation structure needs an update and how to pay or receive bonuses in the most tax-efficient way. We are also blessed to welcome our speaker, Verónica Parellada, CEO and Wealth Management Advisor at My Investment Path, and Juan Mercadal, Business Owner at Orange Business Solutions. So without further ado, please take the stage to start your presentation. I'll now hand it over to you to begin the presentation.
Hello, everyone. Since we're in Miami, we might allocate maybe 1 minute for those who are late. So I'm gonna use this opportunity to say thank you to all the people that are gathering here today. We are My Investment Path. We are members of the Spanish-US Chamber of Commerce. And today we wanna provide you some tools to prepare for 2026 and end up 2025 successfully. And along with me, I have Juan Mercadal, who is gonna co-pilot the session, and he's a director at OBS. So I'm gonna introduce myself while we wait for people to join. And I'm Veronica Parellada Eller. I'm a CEO and a wealth advisor of My Investment Path. We provide financial security, investing and wealth strategies, and I'm a serial entrepreneur with several companies, and I have an extended investment expertise here in the US. So go ahead, Juan, and introduce yourself while we wait for more people to connect.
Okay, thank you, Veronica. Thank you for inviting me to this webinar. My name is Juan Mercadal. I own a business, a tax preparation and accounting practice. We are located just in front of the US Spain Chamber of Commerce, 2100 Coral Way. We specialize in serving clients with an international tax and accounting and cross-border compliance. That I would say is the basic thing that we do, helping clients that have like part of their assets or their economic activity overseas and part of it within the US. We also create companies. We provide comprehensive accounting services and tax preparation, compliance, tax planning as well. And I would say trying to optimize your taxes as much as possible, taking into account all IRS and the state legislations. And that's what we do. And we've been serving clients since 2008. The team, we have a local team. You can come and visit us in the office whenever that you guys want, and we'll be very happy to serve you and to help you with all your accounting and tax needs. I'll hand it over again to Veronica, which is the main character in this presentation.
Oh, we can hear you, Veronica. Now.
Thank you, Juan. So the reason we are bringing Juan today as well is to help you educate and complement all the tools that we're going to show to you and for this financial checkup that you should be doing yearly, or at least yearly, and that's for the best of your results in the long run. So today's key learning points are going to be 5. Where are you standing today? We're going to provide some assessment tools that you can use yourself to see where you are right now. So same as a business individually as a person, you should also do the same for yourself. Sometimes we do a lot for our companies. We don't do those same things for ourselves. Then we never think if anything can happen to us, but that has to be taken into consideration as well, because sometimes it's a time-sensitive moment that you have to do certain things, and this will be by the end of the year. So this is a great moment to think about that, and if we are covered or we have set up a budget for unexpected events for 2026. Then we're gonna give you some ideas on how to legally reduce your taxable income before December 31st. This is also time sensitive. Maybe you do already have retirement accounts. We're going to speak about that and other tools that you may use. And also, if you are a small business owner and you have a company structure here in the US, maybe it's time to check, is my company structure right, or should I change my company structure, because tax-wise that's going to be more efficient with me, and that's we're going to have Juan in the spotlight for that one, comparing the 4 main structures here in the US, like LLC, S corp, partnerships, and C corps. And to end up with, we're going to provide you just one example of advantage planning on how to pay or receive bonuses that may have a different tax impact on your personal income or your company income. So let's go and start with the tools on assessment. And for the assessment of where you are at, we're going to use 3 main tools. The first tool is going to be your personal financial statement. The second tool is going to be your budgeting your cash flow. And the third tool is going to be setting the goals, budgeting your goals, and earmarking what of your excess income is going to go towards those goals. That's like the basic checkup, the first step on this 5-step process that we want to show to you today. So this is just an example of how a personal financial statement would look like. Same as in companies, you have assets and liabilities. You do have the same in your personal life. So we recommend you that you make a list of all your accounts, all your properties. This is just a small screenshot of a very long list, that an example of all the assets that you may have and all the liabilities that you may have. Being a business also part of your assets. So in cash and equivalents, we would have investments and accounts in any bank, other personal properties you may have, real estate property, business real estate, but also your own business is also an asset. So you may not have a current valuation of your business, but your business is also an asset, maybe transferable in the future. You can exit it, you can sell it, you can have a partner in the future. So you should also take that into account, although it's not here in the screenshot. And on the liability side, you may have notes on your business, or personally, you may have that those payments that you have on your car, so that loan that you to purchase your car, you may have a mortgage on your properties, you may have credit cards that have a little bit of debt. So this is going to be very useful to see which of those liabilities have a higher interest rate, because then you can organize them from the highest interest rate to the lowest interest rate. And when we earmark what to do with the excess cash flow, you can allocate that excess cash flow on first getting rid of those liabilities that have a higher interest rate. That would be an example of a healthy financial step that you can now take into account. Now we're arriving to the end of the year, so you should work on your monthly budget. This monthly budget, you can use these or whatever other type of, this is an Excel sheet. What we recommend to do is go over, you may have it in your mind, you may do this or you may not do this, but if you have not done it, we recommend that you do it, because it's gonna provide you at the end of the calculation. So you're gonna put all your expenses from housing, household, loan payments, transportation, medical insurance, and others, discretionary fund, travel, whatever. And all of that plus your income is gonna provide you. So with your monthly net income, you may have different sources of income. You may have your business, you may be a consultant and also get other income. You may have interest on investments, you may have other types of income, but with your monthly income and the expenses that you can calculate using this or any other Excel sheet, you will know what is your surplus. I don't know if you see my little hand, but at the bottom on the right, you're gonna have a surplus deficit monthly, and this surplus deficit is gonna give you a number to go to the next step, which is earmarking your goals and budgeting and allocate this surplus or deficit to those goals. Also here in the budget, in the cash flow, we recommend also taking care of emergency funds. So if you don't have an emergency fund, that's something we're going to discuss in number 2. Are you prepared for the unexpected? But you can also use this sheet to see if you have the right amount of emergency fund needs. And if you don't, then you can allocate part of your cash flow, and you can, that can be one of your goals. So the end of the first step of assessing where you are and what you want to do is set those goals, budget those goals, and earmark that excess cash flow that you got from the cash flow sheet, or even some savings that you already have into the asset and liability personal financial statement. So this is just a rough example of a goal. A common goal that people have is retirement. You maybe too early for you to think about retirement, maybe not. But if you take into account now what retirement income you want to have in the future, it might be in 30 years, 20 years, just 10 years in time. But this is going to be very useful, because then from now to the end of the year, you can allocate part of your income of 2025 to those retirement accounts, and you can have some deductions. So this is a goal that you really need to take a look before December 31st, because there are different options for retirement, and this is one that is very useful. Another common goal would be buying a property, moving, getting married, buying a car. So there are different sets of goals, or expanding the business. This is just one example of one of the common goals that you may have. And other goals for people that have a family and they have children, maybe legacy, or protect your assets, or protect your business if you have a partner. So these are several different goals that you may have, but it's going to be an individual work that you have to do and set up, which is what is your individual one. So secondly, once you know where you are and you have your goals, you have to think, stop a little bit and think, but am I protected against unexpected events? Because all this plan is great, and you may have the retirement goal or buying a property goal, and you may be saving towards that goal. You already earmarked, like, okay, so starting 2026, I'm gonna allocate 500 per month, 1,000 per month, 5,000 per month, any number that you have an excess towards expanding the business, towards funding the retirement account, maybe 2,000. But have you taken into consideration risk management? Because if anything happens to you and you have to go to hospital, you know, here in the US, health expenses may be super expensive. So that would be one of the examples. But one of the first things you have to check is, do you have health insurance for 2026? Because open enrollment, which is the period where you can shop and purchase health insurance, is going to end in December 15th. So if you don't have health insurance through your company, you should be looking into the marketplace and shop for health insurance, because that can be ranging from $30 per month, $100 per month, maybe $800 per month. You may not need it, you may have it, but if you don't have it, you should check it now. You only have 1 week left to check for this. And the other thing, very important, I already mentioned it in the cash flow, is the emergency fund. Do you have an emergency fund? Something happens, your car breaks down, you need to buy another car. Do you have it? Something happens in your house, you don't have a property insurance, you need to change something. If you get sick, maybe you're not gonna have income for several months. Do you have enough money in your accounts to fund your expenses, your monthly expenses? So a rule of thumb would be, have at least from 3 to 6 months of your monthly income as an emergency fund. Then another way to block this, if I get sick, what's gonna happen? I'm not gonna get my income, is disability insurance. So disability insurance is also available for business owners. If something happens to you, you may get 60, 70% of your income while you are disabled or you're sick or you're ill. And then also we have key employee insurance, because you may have a key employee. And what happens if your key employee, maybe a manager, might be a director, maybe your best salesperson in the company, maybe the person gets sick as well. So you may have also some other insurance to provide the income that this key employee brings to the table in your company if that key employee, something happens to it. Other tools that you may, that you may think about, maybe it's too early for that, that's not as urgent as these other 4, will be trust and succession of your company, and the life insurance if you have a partner. If something happens to your partner, is the share of your partner gonna go towards the family, and then you're gonna have to deal with other people that are not proficient in the business to deal with the business? You may have life insurance on each other, and if something happens, you can purchase the part of your partner and the family gets the money right away. So you can have a buy-sell agreement for some key events. Then, yeah, we're already on the third one. So legally reduce your taxable income. So we have several tax buckets. I don't know if this is, maybe it's going to be too much for today, but I'm going to try to summarize this. You have 4 buckets. A taxable bucket, which we like the regular checking account, the income you are getting, and capital gains if you had an asset and you sold it. Then you have a tax deductible bucket, which means that anything that you put into those accounts are going to be deductible to your income. And that's something that you have to consider now by the end of the year, because if you have a 401k, you don't have a 401k, you have other type of retirement account, this is the moment to take a look into that. If you have a high tax bracket, it's better to allocate, although you are going to have less cash at the end of the month, but it's a good strategy to put some of your income into those retirement accounts and have a tax deduction, so you're not going to have you're not going to be paying so much. You may even lower your tax bracket doing so. Then other tax advantages with 1031 exchanges, which is exchanging one investment property for another. And so in that case, you wouldn't be paying capital gains, you would be deferring those. That would be in the tax deferred bucket, not in the tax deductible. And then you have a tax deferred. What is tax deferred means? It means you don't pay tax today, but you're gonna pay tax in the future. So these contributions on the retirement accounts have two advantages. One, if it's a regular tax account, because it can be tax-free, but if it's a regular retirement account, you're gonna have a deduction on your income for 2025. But also, all the gains are gonna grow tax deferred into that account until retirement. And once you pull off this money, you're gonna pay your taxes afterwards, your income taxes from the tax deduction you took, and the gains afterwards of the portion that you're taking out. And then you have also tax-free strategies, which include retirement accounts that are Roth. Roth is a fancy name of this guy that invented an after-tax contribution. So you pay tax first. If you're in the low tax bracket, instead of doing a tax-deductible contribution, you can pay your taxes first. Let's say you pay 13%. Maybe it's better you pay your taxes first, and then you contribute to a Roth retirement account. And you can also use other more sophisticated, like life insurance, to pull money tax-free, but that's not the topic for today. Then we're gonna have these capital gains strategies also to defer. If you invest in real estate, you're deferring gains until you sell the property as well. If you have a company, you can set up a group disability insurance, and you can have a deduction for the contributions you do for your employees. You can do also, by the end of the year, tax loss harvesting. Tax loss harvesting, which is the third bullet point on the left, would be if you're in the high tax bracket and you have investments already in place, you may want to sell those investments that are losing, waiting for a month in January, by the end of January or February, reinvest that tax loss that you had. And that's going to provide you a deduction on your taxes. Then you can also set those retirement plans if you don't have them in place. There are many different retirement plans. It's not the topic for today. We can discuss it in another conversation or another webinar. Choose the right structure. That's one of the main reasons we have Juan here. And he's going to give you an overview of advantages and pros and cons of these structures for your companies, because maybe you are taxed through and it goes to yourself. Maybe you want to block that taxes and keep them into your company. So you may want to think about changing your structure for your 2026 taxes. And then you have related business activities or related businesses. What do I mean by that? You may have a company in Spain. You may have another company here. So maybe you can invoice if they do have a related activity, and one has been very successful, the other one didn't go so well. Maybe you can invoice and help each other in the income, so you can be more efficient in the taxes you're going to pay in each country. That's one of the strategies that you can do. If you have two companies, let's say if you don't have two companies, that's not for you. But if you have two companies or more here in the US, or one in the US and one in Spain or in another country, you can use this strategy. And now I'm going to hand it over to Juan. This is hardcore law and tax.
All right, thank you, Vero. Well, I don't want to bore you guys with all the information. I'm going to go to the basics. The basics is that there are two types of company in the US: the pass-through entities, which are the partnerships, the LLCs and the S corporations. And pass-through means that all the profit or losses of the company go to the owners of these particular companies. And then there is the C corporations, which is the C corporation pays its own taxes. And so it keeps the economic activity of the company separated from the owners if there are no payments from the company to the owners. So there is no perfect solution. There is no perfect structure. There is no better or worse per se. It depends a lot on the situation, on your current situation, and what your business does. Was it a business economic activity? There are other considerations like family. What are your goals? So to plan for the next year, you need to plan for your business. It's not that you're going to be choosing an LLC or a C corporation because you pay more or less taxes with that. It's part of the equation. But the most important part is decide what you're going to be doing with your business. Why I say so? Because if you are considering maybe getting funding from external sources, or you're building a startup and you're going to be selling some of the stock in any way possible, maybe a C corporation is going to be your best bet. If you have a rental property and that's you have it with a friend or with family, maybe an LLC is the best way. If you are a professional and you're consistently having, I would say, approximately $100,000 in profit every year, S corporation could be the most advantageous, and you're going to be having like a better tax situation with an S corporation. So it depends a lot on what you're going to be doing, and I will be very happy to answer your questions and have a consultation with you guys and see which one is the best for you. But you gotta look at your business, what you're gonna be doing, and if there are any significant changes within your business. You have new employees, maybe that you're gonna be paying. You wanna pay your wife, your kids in payroll. Maybe you're gonna have a payroll yourself, and you wanna be more organized. So all those life changes are gonna affect how you structure your business. The good thing here in the US is that it's flexible, and you can start with an LLC and then later convert the LLC to an S corporation or to a C corporation if needed. So and you can go back to an LLC. I mean, there are some tax consequences of doing all that, but it's pretty common to do it. So you have to look at your full picture of how your life and your business is doing and what you want to do with your business, and then make a decision. As I said at the beginning, there's no perfect solution, but there are some solutions that are more suitable for your current situation. So that's basically it. Tax-wise and for tax deductions like the ones that Veronica said earlier, like retirement plans, like 401ks, SEP IRAs, things like that, you can do it with any kind of company. There are some details that you need to, and limits that affect how much you can contribute to those retirement plans, but you can do it with every kind of company. So if you guys need to do any changes, that's the perfect time to do it. The end of the year, there is good opportunity to look at the full picture of how your business did this year. Maybe make the decision, or maybe you have some plans for 2026 and you need to organize the business. So that's the perfect time to think about what's going on with your business and if you need to do any changes. And if you do, I will be very pleased to have a consultation with you and decide on what you guys are going to do and help you with that. So then if there are any questions, I will be very happy to assist with the questions, and I'm gonna return the presentation to Veronica, and thank you.
Thank you, Juan. So yes, it's very important. So I didn't know. I just learned that with an S corp you can have payroll, which is very interesting. And so I might be asking myself to you. I might be taking advantage of your offer. It's very important that you guys have a team in place, and anything you do, you have different experts helping you out if you cannot do it yourself. If you know how to do it yourself, it's perfect. But so the S corp, it's pretty interesting now that you mentioned that. And yeah, so I'm gonna go to the end, and I just want to add on the C corp, because we may have international people watching this, and if I want to stand out a difference with an LLC, a C corp. A lot of people set up a business with an LLC structure when they come to the US, and they're not fully aware of these pass-through tax implications. And so if you are not living in the US and you have an LLC, you're gonna pay taxes as an international. Please, Juan, confirm or not confirm if I'm right or wrong.
No, you're right. And it makes a big difference if the shareholders or the owners of the company are US residents or they're not. So basically what happens is if you're not a US resident, you're gonna get withholding on any profit that the company is making. That's for like ordinary income and for capital gains as well. And then if you sell real property and it's through an LLC or even a C corporation, that's not very well known, but even if it's a C corporation, there is FIRPTA withholding, which is 15% of the selling value of the real estate property. So those are like big implications for tax, because you need to then file a non-resident tax form, like your personal taxes as a non-resident, but especially it's because of the withholding. I mean, you're going to be sending the money to the IRS and then filing your taxes, and yeah, you're going to get some in return, most likely, not in every case, but in many cases you're going to get a refund of what you already paid with the withholding. But that's going to mean time that you're going to be not able to, to invest or spend that money because the IRS has it. And for example, if you sell a property beginning of the year, you got to wait till the end of the year and the beginning of the next year to file your personal taxes. So it's going to take time.
Yeah, and but the C corp has this feature that you're a domestic.
Sometimes it goes under the radar, but that the IRS rules that if there is any foreign partner and you sell real property within the US and there are foreign partners of the C corporation, you should be withholding the percentage allocated to the foreign shareholders. So the truth is that it's not a common practice to do it, but that's the rule of the IRS. And sometimes it flies under the radar, but you got to be careful with all that. Yeah, when you have foreign owners, it gets complicated.
Yeah, and I'll jump to the last one, and we're almost over. So this one is not as important. It's just for you guys to know that there's some stuff that can be done, and not a lot of people are aware of this. It's just an example of how to structure a bonus with financial advantages. So you may have a key employee that you issued a visa for, and this person came from Spain, came from Latin America, whatever, and you're afraid of this key employee leaving the company. So it's a key employee. This employee leaves the company. You're gonna have to find somebody else, maybe file for another visa, and this is gonna have an impact on your company. So instead of paying a cash bonus by the end of the year, you can allocate the end of the year bonus on a very sophisticated and not very well known vehicle, which is a corporate owned life insurance. How this works is the amount of money you are gonna give to this key employee, goes into a corporate-owned life insurance, and it stays there. So let's say you want to hold your employee for 5-7 years. So you fund every end of the year, you fund the bonus. Instead of providing it to the employee, you fund it into a corporate-owned life insurance, and you do that for 5-7 years. That bonus is vested. If you do this with after-tax company money, this employee, after he's for 5-7 years with you, you will give that employee that corporate-owned life insurance, which is fully paid, and it has cash value. Cash value means that the money that you put in has two values: the death benefit, but also cash value. That money grew, and it has a value that it doesn't have any tax. That's something for another. It's a very extended topic, but what I wanted to point out is that you can fund a bonus with after-tax company money for your employee to stay there and receive that bonus. It's gonna promote a good behavior or not leaving the company. Once this employee has the green card or has a need to visa, and they can switch companies, whatever, because they have more freedom and they have access to other employment offers, they're not gonna want to leave because they didn't get the bonus yet. They'll want to stay with you until they accomplish those 5-7 years of vesting that money that's going to go towards them, and it's going to go towards them tax-free if you're structuring it the right way. The same way you can fund for a business owner your own bonus, or for buy-sell agreement, as I said that before, if you're 2 partners or more, maybe you can have this bonus for each partner growing as a corporate-owned life insurance, and then if something happens with this life insurance, you can buy the share of the other partner, or you can use the cash value after several years. You can also have the cash value. So that would be it. I recommend you guys take a moment to sit down. It's gonna take a few hours. It's a lot of work. It's not easy, but it's worth it. Take a few hours. Stop for a full day. Sit with your family, with your partner, with your special one, or sit by yourself. Take a moment to do this health check. Use the tools and find where you're at. And if you need any help, we're here to help you. But we hope this is helpful for you. And use any professional you have in your hand. Use your CPA, a consultant, a financial advisor, your banker, anybody that you have on your hand that can team up to help you, and use them. So I have nothing else to add. So if you have any question, I will pass it back to Bea, and let us know if there are any questions.
Thank you, Veronica and Juan. This was super helpful and such a clear and insightful presentation. At least for me, I will have to review it and sit with my with my partner and see how we can do this better. Well, before we open the floor for questions to the attendees, I'd like to advise to everyone that you can submit your questions tab on your screen, and we'll do our best to answer as many as time allows. So it looks that for now we don't have a lot of questions, probably because the information was very clear, but we do have a couple of them. So I'm gonna start with this one, that is, how often should we review our financial plan to ensure we're optimizing for taxes?
I would recommend minimum 1 time per year. If you have a tax advisor or financial advisor, you can use your advisor to do it quarterly to see if you are on track or there has been any changes. Because if you have any changes, or as soon as you have any change in your life or in your business, you should go over it. Go ahead, Juan.
I agree 100%. Every time you have a change, you know, you gotta review everything. So yeah, at least once yearly. I agree 100% with what Vero said. Yeah.
Okay, perfect. That's helpful. We have another one here. Do you see any emerging trends in investment strategies for 2026?
That's a tricky one. Yeah, so that's a very good question actually. So yeah, for 2026, I would say is the alternative private markets time. There has been a lot of turbulence and a lot of changes today. We don't know if the Fed is gonna lower the interest rates again or not. The markets were very paused for the past few days because they didn't know what was gonna happen. But regular investments, with the interest rates going down, fixed income is not looking as nice as it was before. It's still good for safe. It depends on your risk. It depends on your risk profile. Like as any lawyer would say, it depends. But it depends on your risk profile. How much do you have to invest? If you are more aggressive investing, or if you have really a lot of excess funds to invest, then you can still have a little bit in the market, or maybe bet against the market, like the VIX fund, like the market's gonna sink. But I would say private credit, private markets, alternative investments are, it's a very good time for alternative investments, and there are some ETFs that provide very high income, but those ones should be allocated in the right tax advantage vehicle. So you need to have a vehicle that is the right vehicle, because it's not just what investments, but what about you? Do you have the emergency and the risk mitigated? And do you have the right vehicle to invest? Because are you going to have it in a taxable bucket? You're going to pay a lot of taxes. So those are things that you have to look into, not just like, oh, I'm going to invest and whatever it costs. I hope it helped. If you need anything else, look, you can follow up with another question.
Thank you, Veronica. I'm sure it helped. Okay, and the last one here is, what do you consider the most important factor when building a personalized investment portfolio?
As you have seen, doing a financial assessment is not just one thing that you have to take into consideration, because there are personal situations. Do you have family or not? Do you have excess in your assets and liabilities? And are you covered for risks? Do you have anything in place? Do you have an emergency fund? Are these really your funds to invest? So okay, once all these questions are answered, your risk profile and your goals are going to be the next to allocate in investments, and what you already have in place. Because if everything is in real estate, don't go in real estate. Okay, and then I'm going to use the best word ever, which is diversify. Diversify. Don't put everything. So if you have in real estate, don't put everything in real estate. If you have everything in stock market, don't put more in the stock market. So it depends on you, and what is the screenshot of your financial situation and your personal situation, your business situation.
Great, thank you. So I have one last question in here, but it's about if we will have access to the presentation and the recording after the webinar. So yes, we'll send the recording after the session along with their contact details. So if anything comes up later, you'll be able to reach out directly. Okay, so we're reaching the end of today's session. And we want to sincerely thank everyone who joined us, and of course to our panelists, Veronica and Juan. We hope you're living with fresh ideas, practical insights to take your business further. Feel free to explore more events and business resources at our website. Don't hesitate to reach out. Finally, we will share the recorded session after the webinar, and you can also find more webinars in our YouTube channel. So that's all for today. Thank you, Veronica and Juan.
Thank you, Bea.
Thank you, Bea. Thank you, Vero. Thank you.
Thank you, Spain, U.S. Chamber of Commerce.
Thank you, guys.
Thank you.